All right, hey everybody, welcome to Korean Lens and Mentorship. So I just found this TikTok profile, debt free with Tynell. It says I'm 30 with $800 in my checking account, 55,000 in credit card debt, and 70,000 in student loan debt. And so, yeah, oh man, that must be a pretty tough situation. I think I have another video of his open right here. Over $55,000 worth of credit card debt and personal loan. So let's go ahead, watch, react, and then afterwards, try to pay off debt using our own simulation with something now we call the velocity method. So let's go ahead and watch.
$25,547 in a personal loan debt, $15,122 in a credit card debt, and a little over $12,000 in another personal loan debt. That's a little bit over $55,000 worth of credit card and personal loan debt that I've been trying to pay off for the last 6 years. This has been something that has been so challenging for me to do. And I know you probably are thinking right now, why have you not filed for bankruptcy? And that is a good question. And the real reason why is because I've been trying to do the right thing, and that is to pay this off because this debt I took out on my own. And I'm trying to do everything that I possibly can to not have to tank my credit score and have to go years of trying to build it back up because I want to in the future be able to invest in properties and even buy my own house at some point in time. But it's getting to a point where I have to start being realistic. And if I can't get this down significantly at the end of this year, I'm going to have to do the inevitable and talk to a lawyer about filing bankruptcy because that just might be the only option I have. But what I plan on trying to do in the meantime is make as much money as I can make on social media through brand deals and just what I can make off the platforms themselves to hopefully try to make a huge dent in this and take you along this journey to see if this is possible. And I'll share every single update on this and the tips and tricks that I learned to help me through this if this ends up being the case. But at the end of the day, we're going to have to see what happens, and we may just have to file bankruptcy and deal with what comes with that. But I'm curious to know, if you were in my situation, which one of these would you do? Would you try to do everything that you can to pay it off? Or at this point, would you already have filed bankruptcy and just moved on from it? 20
So if you know how bankruptcy works, there's like chapter 7 and chapter 13. So chapter 7 is like a complete liquidation of your debt, but there's restrictions to it, right? Like if you make too much money, it's way harder to declare bankruptcy, or it might even be impossible to declare bankruptcy if if it's consumer debt and you make too much money, right? And so it depends on how much money you make. And I wonder how much money this guy makes, because this is what's not always clear with these debt-free, people who aspire to be debt-free videos. So $800. So what does he do? What does he do for a living? I'm very curious, and let's just take a quick look at his channel. So 45 following, 54 followers. Wow. I haven't even done a brand deal and I have 4,900. So I'm wondering, if the social media juice is going to be worth the squeeze. Anyways, all right. Well, let's just be a little bit optimistic here and try off debt with something that we call the velocity method, formerly known as velocity banking. So what is it? It's a debt payoff strategy where you throw all of your money into debt with the help of something called line of credit. So first step is basically you have your income, or you create a budget, right? Your budget is your debt attack plan. You have your income, expenses, leftover checking and savings, and then you create an expense breakdown, right? So which is all the debts. Well, you have to create an expense breakdown in and with every single debt that you have, you put it as a line item in your expense breakdown, and then after you've listed all your debts, then in the final line, you could just kind of create an average of all your personal expenses that are not tied to debt. So really easy examples: food, gas, insurance, and all the other good stuff. And then what we do here is we copy this income, same expenses, and we deliberately don't save money, right? We don't put money left over in checking and savings. So the difference between here and here is that we treat our checking account as the final destination of our money, what we call average American banking. But with the velocity method, the final destination of our money is something called a line of credit. So after every single month, ideally the balance of the checking and savings would be zero. And this is why it's so hard for people, because we're socially conditioned that we should save money. And if you think about Dave Ramsey's first baby step, he says, hey, if you want to get out of debt, save $1,000. Right now, in this case, it might be relatively easy because it's just 2 months. But instead of just saving $1,000, why don't we just use all of our money to attack debt, right? And so we're going to assume we have access to something called a line of credit. So what's a line of credit? It's basically a financial tool where you can borrow money, pay it back, and then use it over and over again. So there's personal lines of credit, business lines of credit, home equity lines of credit. Um, a credit card is technically a line of credit, but the only difference between um, a, a credit card and let's say a personal home equity is that credit cards have some restrictions in the flow of money or in the movement of money. So, for example, I can't use a credit card to pay a loan, right? But with a personal or home equity line of credit, all I have to do is click a button on the bank's website and they'll dump money into my checking account, right? So I can use that cash to pay anything in my checking account. So, what we're going to do is we're going to rank these debts using something called the cash flow index. And so, what is the cash flow index? Let me just kind of show you right here. Basically, it's the balance of the debt. So, let's say we have $5,000 balance in our credit card divided by the payment amount, right? And then we do this for pretty much every single debt that we have. And let me just actually copy and paste this right here. So, whoopsie, copy and paste this right here. And then let me also do it for the loans as well. So I'm going to copy and paste this from my loan calculator. And so what this is going to do is give you a reference of which debts to pay off in which order. So the lower the number, that's the debts you want to pay off first, and the higher the number, that's the one you want to pay off last. So you could kind of think of this number as like bang for your buck. So the reason why I don't want to pay off my mortgage first is because I literally have to give the mortgage company $330,000 to only get $1,500 back in my cash flow, right? Whereas with my credit cards, this is 15, so this is about 28,000. And actually, let me just go ahead and sum this up, right? And I'm just going to go ahead and sum it up. So that's 857,000, or not thousand, $857. So I only literally have to give 28 thousand dollars to get about half of the mortgage payment. I don't have to give like 100,000, or what's 330 divided by two. I can't even do math right now, but let me just do this. 300 divided by 2. I don't have to give 165,000 to get half of this, right? I only have to give 28,000 to get half of the mortgage payment. So hopefully that makes sense. But basically it's about bang for your buck. So you want to pay off these first. And so what we're going to do is we're going to shift some money into the line of credit, or shift some debt into the line of credit to increase our cash flow. And we're going to start off with these low cash flow indexes. So how much is this again? This is 5, 8, 15. I'm going to go ahead and sum it up. So that's $28,000 in credit card debt that we're going to move into a line of credit. Now, we're going to assume we have a free and clear line of credit. At this stage, it might be questionable whether the bank will lend you a line of credit or not, because what's the number one rule of banks and banking and who they lend to? Banks don't lend money to people who need it, right? So if it looks like from their eyes that you need money, they're never going to give you a free and clear line of credit. So it's important to get all the credit that you need before you ever need it, because the moment that you need it is the moment that they won't give it to you, right? The bank is a risk mitigation institution. It's not your friend. And even though they lie to you in the marketing about they'll be there for you when you need them, that's a total lie. And they somehow get away with it. Okay. All right. So now we just do the final step. Actually, not the final step. There's one more step. So now that we've transferred this credit card debt into the line of credit, take a look at this, right? These credit card payments now go to zero because it's just like doing a debt transfer, okay? Like a balance transfer. So here we see that this $562 has now somehow transformed into $1,420, $1,400 and 20. I can't even speak today. Maybe it's because I made 5 videos, or this is the fifth video I'm making. But you see, that's the same income. The expenses have just been shifted, but they're all still there, right? And now the $562 is now $1,400. And here's the final step. We're going to put our entire paycheck as an overpayment into the line of credit, take our expenses out, and then after every single month, the balance of the line of credit should go down by about $1,400 and some change. Okay, so let's go ahead and do this. So I2 plus 1. Okay, so to get next month's balance, you get the previous month's balance, previous month's interest minus our cash flow. So let's go ahead and do that. And if you want to calculate the average daily or the interest, it's based on the average daily balance. Multiply by the interest rate, divide by 12. And usually with home equity lines of credit, um, the interest rate is 8%, and then personal lines of credit, it's 15%, right? That's just been my experience. So let's go ahead and copy and paste. And then we see here that in 22 months, okay, that in 22 months, that credit card debt has pretty much been paid off. So I'm going to do this 22 months, 28K, and then we're going to go ahead and write this down. And then now we have three more loans: student loan, auto loan, and the mortgage. So luckily we have these loan calculators to determine what the balance is if we just put the current months of all of these. Now I know what some of you might be thinking. Wow, we should tackle on the student loan, right? Because it's like 6% highest interest rate. Let's get rid of it. Okay. I tend to prefer the cash flow index, and I actually use that method or start to use the method when someone sent me their spreadsheet of numbers with $5,000 of income and 22 debts. And we actually went over that real life case scenario in a live stream, but that live stream is for YouTube channel members only, 99 cents. So if you want to join, go ahead and click the join YouTube channel member. But or memberships. But here we see that even though that this is the lowest interest rate, the cash flow index is saying pay this off, because if you pay 16 grand, you get $449 back in cash flow. Whereas if you pay this 42 grand off, you have to pay 555. Okay, so let's go ahead and then move this balance of the loan, of the auto loan, into the line of credit. So I'm going to go ahead and do this, and then plus 16265.12, and then this is going to be 0. Okay, and then now our cash flow is 1800. Okay, our cash flow is 1800. I'm going to go ahead and copy and paste. Okay, so 1869.43, and then I'm going to go ahead and copy and paste, and then this is going to be 31 months to 31 months to it's all paid off. And then so I'm going to just do this. So equals 28 plus 25. So that's 53K. Okay. And then now we just have two more loans, the student loan and the mortgage. So let me just kind of do this right here, 3131. And so now the balance of the student loan is 39 grand. The balance of the mortgage is 314. Let me just check if I did this correctly. Yep. So, and now again, just use a cash flow index. So here's the thing about the cash flow index. Anything you want to be careful of paying or moving anything in a line of credit where the cash flow index is over 50. And then if you move anything over 100, you really don't want to do that, right? Because let's say like you move this 4% loan into an 8% line of credit. Let's say it's $300,000 and you only get this itty bitty amount of cash flow back. That's you're going to end up paying a lot more interest than you have to. And I've demonstrated this in other videos. So what we will do in this video is use something called chunking, where you're moving a piece of the loan into the line of credit. And I'll show you that even if you use like a 15% or even a 30% line of credit, um, yeah, you probably the higher the interest rate, you do end up paying more, but it's not as much as you think it would. In fact, I actually tried this with like a 0% loan recently, and then it's like, okay, if we have a 0% loan and we tried this chunking method with the 8% line of credit, it was only like $2,000 of interest over the life of the loan. So it's not okay. So, and a lot of people get confused by this because there are a lot of people out there on the internet saying, "Hey, always move a loan into a line of credit," and that's actually not true. But let me just show you the chunking calculator. So give me one moment to open it up. All right, so here we are with the velocity band calculator. So this is what I did. Okay, so basically I put, hey, if let's say you have a $300,000 loan at 0%, and you actually move $6,000 into a line of credit, how much would you be overpaying? And then you see here that you paid off in 7.6 years, and you actually end up paying $2,700 of interest. Now, a 0% loan, 30-year loan, as far as I'm aware, they don't exist, right? But I'm just saying, worst case scenario, what could happen if you go from 0 to 8, right? So there is a lot of, a nuance when it comes to doing this. But what I'm saying is that I actually like doing this method just because it makes the debt payoff easy. And the reason why I would do this is because it prevents something called segregation of income. So one of the things that the tenets of this method is that you're going to put all of your income in one place. Whereas when we're here, what happens is we our money comes into the checking account, it gets split all over the place, and then we're supposed to put our leftover in checking and savings. So we're trying to prevent that even as we're paying off the lower interest rate debts. But you can make an argument like you see right here, oh, this is a 0% loan. Why in the F would you pay a 0% loan with the 8% line of credit? Um, right? But even if you pay off lower interest rate loans, that you'll see that the savings is there, although you might slightly overpay if you're using a really low interest rate loan, right? So, anyways, let me go back here and put in the details. So let me just do this. So this is going to be, okay, let me just put the income and expenses first. So the income is $6,000 and the expenses is everything except for the loan we're trying to pay off. So we're trying to pay off this loan, so our expenses are these two right here. And then I'm going to go ahead and save it. So it's going to be 3575.47. So it's going to be 3575.47. And then we'll do a $6,000 chunk amount. So you just need to do a small amount, right? Like you don't have to do big amounts with the line of credit or put an entire first lien HELOC on the mortgage. That would be insane. All right, so now what's the current balance of the student loan? So the original balance is 50,000. 6%, 10 is the term, and I just have to go ahead and copy it. So 610, 39796.94. So 3939796.94. And then the payment amount is 555.1. And then you see that this gets paid off in 1.4 years, right? So we're going to pay it off. And then I'm just going to do this right here. And then so now this is 0 and 1.4 years. So 31 plus 1.4 times 12. So that's 48 months. And then that's going to be 103K. Okay. And then at 48 months, what's the current balance of the mortgage? So we just got to update a few figures to figure out how long it'll take to pay off the mortgage. So that'll be $2,000 a month right here. And then this is going to be 30 years. And I think it's 4%. And so now it's going to be 330. So 330000. Okay. And what's the current balance? Current balance is 305,294.74. So I'm going to go ahead and copy this. Okay. And what is the payment amount? Payment amount is 1575.47. Okay. And then we see that in 7.5 years that gets paid off. And so if we just keep making the monthly payment, that and then we would have just paid about 186,000. But let me just do this. I want to just show you if we use a 15% line of credit that you see that it's about a $3,000 difference even if the interest rate doubles. And then let me do 30%. So that would be probably be like an $8,000 difference, right? And then you see that 7.6 years, so 7.5 years with the 15%, and then still at even at 8%, it's 7.5. Now, ideally, if we use a 0% line of credit, obviously we pay that off quicker, but 0% line of credit doesn't exist. And really, the best thing would just be to kind of put the whole thing in a 0% line of credit. And in the most ideal situation, it'd pay off in 6.4 years. Right? So a lot of nuance there. But just what I'm saying is that you can still use an 8% or a 15% line of credit to pay it off. You might be overpaying just a little bit, when you're using this chunking method, especially there's a big difference between the loan interest rate and the line of credit interest rate. Okay, well, that's it for today, folks. So good luck to you, Tynell. I wonder what his side hustle is because, if he's going to get brand deals and sponsorships, like what's going to sponsor him? You know, like is he make like if I were making like vegan food and all that, then I'd probably want like a sponsorship for Juicer. But who sponsors like being debt free? Because the bank certainly wouldn't. You know what I'm saying? Okay, well that's it for today, folks. Have a great day, and I'll see you on the next video. It's the fifth video of the day. I can't believe I made 5 videos in one day. It's been a while.